Debt negotiations remain fluid on Capitol Hill. Our next guest says, though, that he is optimistic that a deal will be reached and that it should be bullish for the equity markets. Joining us right now is Tobin. He is the senior U.S. policy and politics strategist for Evercore ISI. And Tobin, I think the market agrees with you that a deal will be reached because you don't see much panic anywhere on these things. What makes you think that the deal is going to be good news for the markets longer term?
Right. Absolutely. Thanks, Becky. Good to be here. Yeah, I mean, certainly markets are treating it as if we're out of the woods. I think we're not quite out of the woods yet, but it sure looks like we're on track there. We never saw, of course, the big kind of panic sell-offs that a lot of people worried we might get towards the end of this process. So I don't know that we're going to unlock a massive rally by getting this out of the way, but it's certainly yet another cloud over a market that's kind of had trouble breaking out upwards. So I do tend to think that eliminating the uncertainty here is going to help. From my conversations with institutional investors, there's been a lot of attention to this. The kind of predicted attention did come as this heated up, and the tension around the likelihood of getting a deal rose over the past few weeks, even though that never translated into massive selling or kind of huge amounts of change to folks' portfolio positioning. But it is obviously not lost on people that this has been a risk, and clearing it up, I think, has to help.
I would almost argue the counterfactual, just because we haven't seen the sell-off, we haven't seen the pressure that you normally would in a scenario like this. The market's looking through this, which almost makes me think there's more downside risk than upside potential.
Certainly, it's asymmetrical. If we see another major setback in negotiations, I think we are obviously set up for quite significant sell-off, given that people, I think, are pricing in an assumption that this is going to get resolved. I don't think that's very likely. It sure looks like they're going to get to a deal. I think the parameters are largely in place. In terms of risks to worry about at this point, I think the clearest and most immediate one is, are they going to be able to line up the votes in the House? Both Speaker McCarthy and Minority Leader Jeffries have never really been in a position of having to round up votes for an unpleasant compromise like this before. McCarthy obviously has overperformed expectations throughout the year. And his ability to keep the caucus unified on, kind of feel-good party line bills, but this is a different endeavor. And obviously, we're seeing the dissatisfaction from the Freedom Caucus types in the past couple of days, since it really is not going to end up cutting spending very substantially. I think it's turning out to look like a fairly good deal for Democrats. And on the other side of the aisle, there is certainly some sticking points for Democrats, depending on what ends up happening with work requirements on SNAP, on the food stamp program in the final bill. So I think probably they will be able to get that done. I have always thought that anything that McCarthy and Biden walk out of the room with, they'll be able to get through Congress. But it could be a little bit of a close run thing. Again, if we do see unexpected problems emerge there early next week, markets are very well set up to react to that quite negatively.
Tobin, another thing we've been talking about this morning is just the idea that if both sides get something out of this, you are going to be looking at spending cuts, and that inevitably will have an impact on GDP, that you're not going to have the same government largesse, the same government spending. And even those who wanted to pull back maybe haven't completely thought through what that means for the economy. Is there the potential for downside? Just, Kayla Tausche pointed out earlier that after the last deal, we did have 2 years of austerity, and that did eat into GDP.
Right. So, I think two important things. One, there's going to be a lot less actual austerity or fiscal consolidation coming out of this deal than some of the top line numbers might imply. I think a lot of the work in the recent negotiations has gone into Democrats coming up with kind of clever budgetary maneuvers to minimize the extent of the bona fide negative impact to discretionary spending. And defense and VA spending is going to go up. So on net, I think we're going to be pretty close to flat. Of course, that represents real erosion given the inflationary environment. But, we're talking about 1, 2, 3/10 of a percentage point of GDP potentially, so not a lot. And then the other huge difference from 2011 is the macroeconomic environment. That was, in a period of persistently depressed labor markets, zero interest rates. Right now, obviously, we're dealing with, if anything, overheating. And so I think that, at the margin, small contractions in government spending look a lot more likely to translate into less crowding out and an ability to absorb that, sort of freed up resources in the private sector now compared to where we were in 2011.